Hi, everyone. Welcome to United Asset Strategies' third quarter investment call. I'm Matt DeLorenzo, Chief Investment Officer, and I'm joined today with Jiorden Sanchez, who is Director of Portfolio Management and Investment Research. To kick things off, we'll start out with a little bit of a review of Q3 and the year so far. So I'll turn it right to Jiorden.
Thanks, Matt. So the major market indices took a bit of a breather in the third quarter, and that at least partially gave back gains from the first half of the year. Here I'll pull up Exhibit 1. You could see here in Exhibit 1B the low single-digit negative return we saw across stocks and bonds in the third quarter. It's worth noting that this came despite persistently strong macro data points and earnings, with higher interest rates the primary driver. Exhibit 1C highlights the year-to-date performance inclusive of that third quarter, and excluding a handful of large-cap tech stocks with strong performance, year-to-date market returns have been somewhat muted. You see that for the typical stock, as measured by the S&P 500 equal weight, which is up modestly, and you see it for the major fixed income indices, as measured by the Bloomberg US Ag and Bloomberg Muni Bond Index, which are down modestly. Now, quickly shifting from the markets to the economy, a key positive has been the surprising strength we've seen there. Entering the year, the concern was that last year's rapid increase in interest rates would restrict macro activity such that we were on the doorsteps of a recession. But if you fast forward, it's fair to say that economic strength has been somewhat surprising. The primary driver of that resiliency has been the consumer, and we've seen strong data points as it relates to employment and retail sales. Now let's pull up the second slide. Exhibit 2A here charts the Citi Economic Surprise Index. Positive green bars on that chart suggest that more economic data points exceeded expectations than missed. And you've seen that that's been a consistent trend through the first three quarters of the year. Better yet, that surprising macro strength has actually directly translated into stronger than expected corporate earnings. And you see that in Exhibit 2B. Earnings exceeded expectations by a wider margin than usual in both the first and second quarter. And it's still early in third quarter earnings season, but so far that strength has continued. Now, that surprising macro strength does have direct implications for monetary policy. So on that note, I'll turn it to Matt to discuss that.
Thanks, Jiorden. As far as monetary policy, the biggest thing that happened this quarter that the market really responded to was the September Fed meeting. So what we saw there was the Fed released an updated summary of economic projections. And in there, they indicated that, amongst a bunch of other things, by the end of 2024, their expectation for where the Fed funds rate should be is actually 50 basis points higher than they previously expected it to be at the June meeting. So the market responded pretty negatively to this, and interest rates went up as a result. And of course, that has a direct correlation with bond prices because as interest rates move up, bond prices move down. What was most interesting about the market's response, however, was that the moves weren't concentrated on the short end of the yield curve where Fed funds has the most control. It was actually the longer term bonds that sold off the most and resulted in a steepening of the yield curve. And we can really attribute that to the market really trying to game out where policy rates will settle out and the increased uncertainty with that, given that the Fed has recently changed course a bit.
So Matt, if I could just jump in here, obviously interest rates also impacted equity markets in the third quarter. And that came despite the continued strength in earnings and the macro environment that we saw during that time frame. So rather than simply draw the relationship between a strong economy and strong corporate profits, the market started to weigh the implications of that macro strength on the likelihood of a higher for longer interest rate policy, and that led equity markets lower. We saw it really in two ways. First, the stock market declined despite strong earnings entirely due to lower valuation multiples. We believe the market assigned lower multiples to stocks due to the increased concern that higher rates would curtail macro activity and potentially pressure future earnings. Second, that valuation commentary was confirmed by some of the market internals. So, for example, we saw most of that multiple contraction in areas that are most sensitive to the economy. These are things like cyclical sectors, small cap stocks, and low quality businesses. So obviously, interest rates impact the equity markets too. And so for an outlook on the direction of interest rates, I'll turn it to Matt.
Thanks, Jordan. Yeah, so this slide here really kind of helps review a little bit of what I had mentioned earlier with the steepening of the yield curve. So if you look on the left side, you notice the arrow we have there shows that there's actually been a pretty significant jump in the yield curve. And what that really means is recently, long-term interest rates moved higher at a greater pace, significantly greater pace than short-term interest rates. So this really has implications for various parts of the economy, and most notably for borrowers. So long-term borrowers, like anybody shopping for a home, looking for a 30-year mortgage, obviously that rate is significantly higher. Corporate borrowers, so big corporations looking to issue bonds, to borrow cash, same thing. So their interest rates are going up. Municipalities, same thing. So in the face of this steepening and higher borrowing costs and tight policy by the Fed, one might expect that credit spreads or a measure of corporate credit risk would increase to reflect some of these risks. But what you see on the right side actually is that credit spreads have remained very tame. So you see the arrow going down there, and that's basically showing you that the incremental yield available for loaning to a corporation instead of the US government has actually contracted. And that's a sign of investor comfort with credit quality as opposed to a risk aversion. So as we're filtering that through to our investment strategy, in the face of the risk that we're seeing and potential slowdown coming ahead, we don't see it as an optimum time to be extending a lot of credit risk and taking more risk in our bond portfolios. So as a result, we have a very up in quality bias. So during the quarter, we further trimmed some more of our positions that contain credit risk that offer a little bit more yield but have run a little bit. So we took some profits there and we're reinvesting in very strong quality portions of the market. A couple of examples are long-term municipal bonds, as interest rates are significantly higher, as well as U.S. TIPS, which are much better priced than they've been in recent years.
So I'll jump in really quickly on the outlook for the equity markets and our positioning. So with interest rates making bond returns more competitive with equity returns, and with a weakening macro environment and potential risk to earnings, some have questioned if stocks are too expensive. And while both concerns are valid, this is where active management plays a role. So here's where I like to pull up Exhibit 4. So let's start with valuation in Exhibit 4B on the right. We see here that the overall market is statistically expensive. As per those gray bars, you see that it's trading at 18 times, which is higher than it was to start the year, and also expensive historically. But if you were to exclude the Magnificent Seven, which are really the 7 biggest tech stocks in the market that everyone knows, the remaining 490 plus stocks are actually at pretty attractive price points. So those stocks, as you see in the yellow bars, are trading at just 14 times earnings, which is not only lower than it was to start the year, it's actually cheap historically. So while the broader market may seem expensive, for an active manager like us, there are plenty of individual stocks to invest in that are at attractive valuations. Now, moving to Exhibit 4A on the left, which talks about earnings. Here we see that there's obviously a clear relationship between the economy and earnings expectations. And so that's done in this chart through the index of leading economic indicators and comparing that to consensus earnings forecasts. With the LEI growth trending lower and now recently turning negative, that historical relationship doesn't necessarily bode well for the future direction of earnings, hence the reason why some investors are concerned. Still, the exhibit also highlights that there are certain parts of the market, like defensive sectors, that are far less sensitive to the economy than other parts, like the cyclical sectors. This again provides an active manager with a path to remain invested, but focus efforts on maybe the subset of stocks with the most earnings resilient profiles. So as active managers, what are we doing in your accounts? The persistent strength in the economy, and earnings makes us cautiously optimistic, but we're obviously not oblivious to the risks present. So to manage that risk, depending on the equity strategy, we have some mix of cash and hedges and stop orders in place, which would dampen volatility and potentially limit downside in a tough market. And then to minimize the impact of a potential recession, we are tilting towards stocks with more resilient earnings profiles and away from those that are a bit more sensitive to the direction of the economy. And then finally, we obviously own a healthy amount of the Magnificent Seven tech stocks. They've got very strong fundamentals. We just own a little less of them than the market would dictate because the valuations are pretty lofty. So in closing, this type of risk management wouldn't be possible with a basket of index funds. And it's pretty key to kind of some of the value add we provide to investors. So with that, I'll close and transition it over to Matt.
All right. Thanks, Jordan. And thanks to everyone for listening to the call. You may have noticed that we've made some changes to how we're putting out our letter and our video recently. So just wanted to mention that any feedback is greatly appreciated. Feel free to shoot us an email, give us a call, and let us know. We thank you for that. In addition, just closing with a couple housekeeping items. Any of our TD clients, as you know by now, have successfully been transitioned over to Schwab. If you have any questions about that, any concerns with logins, anything like that, feel free to reach out. We'll be happy to help. And then lastly, some more good news. We continue to expand the team, this time on the service side, with the addition of Patrice Simmons and Carol Zito. So thank you, and I look forward to the next call.